Hello, class. This presentation is not necessarily just going through the slide deck and going through each page. In this conversation, I want to bring to your attention some transactions and some concepts that I think will follow you throughout the course. This particular PowerPoint is the exact replica of what's in your classroom materials. So I'm going to use this as a springboard, but remember, I'm not reading slide by slide because I'm trusting that you've read the chapter. My goal here is to help you navigate through all this information and get what you absolutely need to help you with your homework problems, comprehensive problems, etc. But I'm going to frame it within the chapter's concepts. And I'm going back to chapter 2 because that's really where the problems start. So if we can tackle chapter 2, chapter 3, 4, 5, and so on would be much, much easier to grasp. We need to get down to the fundamentals. Okay. We are talking about accounting. Whether you're an accountant for an organization or you use accounting information, it's important in essence to understand what we're talking about. Why is accounting so important? What does it really do? And all of the details that make up the accounting process. We begin with standards. Our accounting systems generally is going to be either a cloud-based software program or something on your desktop, but it's designed to be able to help you categorize and record, or in this case, classify transactions in such a way that you can get some useful information out of it. That's essentially what it does. So to do that, you'll need to be able to identify what is a record and what does it mean. For example, if we're talking about accounts and so forth, think about your own personal life. When you go to the store, you're buying a dress. That will be called a dress. It's an asset to you. Or a pair of slacks. That's an asset to you. Something that you can wear, you can use, or you can throw away if you want. The same is true for businesses. They don't necessarily buy dresses or unless they buy merchandise, but they're buying different items that they use to either generate more income or to modify, or in this case, to manage the income that they're generating. And we'll talk about that in later chapters, but really, these are transactions. Every time money is spent or every time there is some commitment of funds, whether it's paid immediately or not, we need to recognize that transaction. We need to recognize it because it happened. It's affecting some accounts, revenue accounts, which is income for you and me, in the form of our paycheck. That's revenue to us. Every single pay period, we get a check, a direct deposit in our accounts. That's revenue. But also we have expenses too. We pay our rent, we pay our mortgage. Those type of transactions for us are going to go into an account called rent expense or revenues, or in this case, wages income. So when you're talking about recording transactions, that's really what you're doing. You're taking a transaction that you or a business has occurred and placing it in an account to maintain a record of it. You want to record that particular activity. What happened with that activity? What did you do? What did you buy? What did you sell? For example. So when we're in our accounting systems like QuickBooks, etc., we're recording transactions in accounts so that we can track what has happened. So when we're recording transactions, you're recording what has happened. Did we get more money? Did we pay money? Did we commit to doing something or some kind of liability that we've incurred? Or did we get money that we might have to pay back later? Those kinds of things. So talking about transactions is important because we need to know we're transacting all the time. And there's no difference really in the transactions that you and I as an individual transact versus a company. We transact with our employees going to work every day. We did the work, they incur the obligation to pay us, and we get the money. It's very, very similar. And in fact, in more ways than one, it's almost exactly the same. So think about transactions in terms of what you would transact in your own personal life and see if you can translate it to a business transaction. And I would say 9 times out of 10, you should be able to do. So when we are transacting business, again, T accounts is a very artificial type of process, simply because there's no such thing as a T account in an accounting software program. But on an academic basis, it is important for us to understand what's happening behind the scenes. Let me give you an example. If you're using QuickBooks to transact some business, and I'm going to show you what QuickBooks look like in just a moment. Now, what you see in front of you is generally what an organization would be using in order to transact or to record various transactions. In the class, you'll notice that a lot of things are done manually, and they're done in a very unusual way, because for many of you, you may not understand, what does a T account mean? And in the real world, T accounts doesn't exist. When I go in to transact a particular process, I want to pay a bill, or I want to record a bill that I've already paid. Looking at what you see here, you would go through and you would put in your vendor, how much you paid, the amount paid, and then all of the data. Here, where it says category, that's essentially the account that you would use. I'm going to use account called rent. I'm going to call it rent and lease expenses. And I'm going to pay July rent. And then I'm going to say the amount is $1,500. Now, I'm going to stop right here and talk about what I've just done. Now, if I did this and I record it, at the bottom here, you'll see save. I'm going to click this. What this would happen is, once I fill in all this information, I'm just going to put in. I'm going to add in. Okay, save it. I'm going to pay in, and I'm going to pay with an asset, and I'm going to pay with my cash, bank account cash on hand. Save and close. So I'm paying with my cash on this date, and will pay from this account basically. And the payment method is going to be in form of check. And I'm going to give it a reference number 222. Now I'm going to put here, I want to make sure cash is okay. So what I'm saying is, when you're going through and entering your transactions, you're doing everything manually. You're doing the debits and the credits all manually. But when you're using an accounting system, it's going to automatically know the accounting procedures. It's going to know, okay, if I'm going to record this as an expense, I know that this is going to be on the income statement. And I know based on that I'm going to put it as a payment by check. So I know that I've also reduced my cash. So what happens when you're doing it manually, you're actually seeing the actual entries being recorded as if the accounting system was doing it for you. So when you're recording your transactions, that's exactly what's happening in the real world. In the real world, where we're going into our accounting system and we're going to tell it, we're going to pay a bill, we're going to tell it who we're paying, and we're going to tell them what kind of category it belongs to. The category is the representation of that account. It's really what the account is. Rent expense is one account. When we're doing all of this work online, it's easy when you're using some kind of software program like QuickBooks. But in class, we're not using QuickBooks. We're actually using Excel spreadsheets and other types of things to do the same thing that a computer would do behind the scenes. And what the point I'm trying to make with you is this. Understanding what a T account is in its essence is not as critical as understanding what we are, why we are doing it, why we're using a T account, and what it represents. And that's what I think is most important for you to grasp. It's really the representation of a T account, how it translates to what's happening behind the scenes when an individual accounting clerk or bookkeeper is actually recording these type of transactions. They will have an invoice in their hand, and they're being told to pay this invoice. They will go into the system and say, I'm going to pay this vendor this amount of money, and I'm going to charge it to this account, but I'm not going to pay it right now. So the system already knows I'm going to debit this expense, and I'm going to credit accounts payable, and that's what you're doing, manually you're doing. So when you're looking at your T accounts, you're saying, well, how does this all help me? A T account allows you to see the balance of an account, a specific account, and all the transactions, debits, and credits that make up that particular balance. And it's very useful because it is also instrumental for us being able to prepare our trial balance and adjust it. So in the real world, an everyday activity, a T account is almost a translation of the general ledger that you would see in an accounting system. What is a general ledger? It's a general ledger. It's all of the accounts and their debit and credit transactions. Boom, 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 all the way down. It shows all of the accounts, or it could show one or two different accounts depending on the accounting system and what you want to look at. Use that T account as a reference point of this is my general ledger showing me only this account because I want to see all the transactions that I have posted to this account to give me my true ending balance. And that's one key point that I want to make. The other part that I want to make clear is when you're looking at various accounts in isolation, they don't always make sense. But if you think about all of the accounts for that organization in their ledger, their general ledger, it's going to be called their chart of accounts. And they are grouped by their actual asset, liability, equity, expense, and revenue. And it's important to know that these are the accounts that we're going to be using to record the various transactions that have occurred during a period of time. They are absolutely important to note that they are most likely going to be ordered in asset, liabilities, and equity. And then the income and expense accounts are going to be ordered as well. The most important thing about a chart of accounts is to know what this chart of accounts gives you. It tells you all the accounts that this particular company has in its ledger. And you will use those accounts in various activities, transactions, to record the activity for the period. So when you're looking at your chart of accounts, what does it mean? If I own something, it's going to be an asset. It could be a liquid asset like cash and money market and petty cash funds, or payroll cash funds, or it could be non-liquid, meaning supplies, receivables, prepaids, and then PP&E, which is plant, property, and equipment. But it's all resources that you own, all resources that you can control, all resources that you can sell or dispose of at your leisure because they are yours. They are your assets. Liability is some kind of obligation. It could be an accounts payable obligation. It could be a salaries payable or wages payable obligation. You owe somebody an asset. At some point, you owe them an asset, whether it's in the current or in the past, or it's a long term, over a year, a year. But no, nevertheless, you owe them some form of asset. The asset you generally will owe them is going to be cash, but not always. But the most important thing is you have a debt to repay in a form of an asset, and that's your obligation, and that is a liability. It's a right to the assets. It's going to be your equity. Equity can comprise of your common stock, your retained earnings. Retained earnings is what you retain, what you keep. If you have earnings of $50,000 and you don't give that money to your shareholders, you're retaining it. You're keeping it. Dividends is what you pay back. So those accounts are related. The dividends is going to be a offset to your retained earnings. It's going to reduce it because you're taking that money that you've earned or the earnings and giving it to the owner. And dividend is a form of return of investment for a stockholder. So knowing that as well, revenues increases in your equity. It increases your equity hands over fist. Every time you earn money, your equity goes up because you have more invested that you can take and use or retain. And generally it's because you sold a product or service. Your expenses are going to be the generation of costs associated with paying, or in this case, generating revenues. It's a cost of doing business. So it's natural that it's going to be a reduction in equity. It is most certainly a reduction in equity. And revenue is going to be an increase in equity. Understand that. So when you're looking at your transactions, you have to think about, how do I understand the process of recording a transaction? The first key is determining what type of account are we talking about, or accounts are we talking about. Are we talking about asset accounts? Are we talking about liability accounts? Are we talking about equity accounts, which includes the revenue and expenses? Are we talking about those? What happened with those transactions? Did they go up? Did they go down? Are we benefiting? How are we benefiting? Are we having some obligation to pay back in the future? That sort of thing. Kind of questions that you need to ask yourself as you learn how to create an environment where you know this is what happened and these are the accounts that represent what had happened. Double entry accounting system. Again, if in the real world of using accounting via Peachtree, Oracle, Sage, QuickBooks, this is already embedded within the accounting software program. You don't have to think about it. But when you're learning it, it's important to understand what the software system is actually doing. And a double entry is going to be, you're going to have an even transaction. There's no entry that you're recording legitimately is going to be one-sided. It's going to always have an equaling side counterpart. Your debits will always equal your credits. It doesn't matter if you have 50,000 debits or different entries and you have one credit. The end of the line is if the total of your assets equals the total of your debits. That is the essence of double entry accounting. We have a double entry accounting system, and our entries must balance. They must agree. When I say they balance, they have to agree. So, in the sense of the word, what does it mean by normal balances? That's a very, very vague concept. But when you're talking about balances in accounts, let's think about them in the group category and not in specific details first. When we're talking about normal balances, we're going to be grouping them in an asset, liabilities, equity, revenues, and expenses. In those categories, those accounts vary and they move up and down based on various types of transactions. And we have to have this basic knowledge that when we are increasing on an account, we don't know if it's going to be a debit or a credit until we determine if it's an asset, liability, stockholders' equity, or revenue and expenses. So debit and credit is not the concern here. You need to know what account it is in order to determine what makes that account goes up and what makes that account go down, and what's a normal balance for this particular account. So let's talk about the accounts and what makes them get bigger and what makes them get smaller. Now, journalizing, I want to get into that in a minute, but I really want to just talk about that because that's a really big deal. If we have asset accounts and we have expense accounts, let's talk about the assets first. When an asset goes up, we have said we are generating something. We have received something. It's some sort of asset of ours. Those accounts will have a normal debit balance. Therefore, if I know assets of any kind, doesn't matter what kind of asset it is, if I have an asset account and that asset is going up, meaning I got money or I got an asset that I've acquired, I know if I'm going to debit it. So if I want that debit, if I want that asset to go down, I have to do the opposite. I have to credit it. Now, we talk about liabilities and equity. Let's talk about those for a moment. An obligation to pay, we're going to have a liability. We owe someone an asset for something that was done in the past. That's the technical definition of a liability. So when we think about that, we have to say, okay, my liability is going to go as a credit balance, and my balance will always show a credit balance. My credit balance is going down. If I have a liability which has a normal credit balance and it goes down, what do I do to make it go down? Oh, I have to do the opposite. I have to debit that. So understanding normal balances matters to the extent of the account that you're thinking about. If you're thinking about a liability account, my normal balance is going to be a credit. So if I want to make that credit get bigger, I want to credit some more. If I want that credit to get smaller, I want to debit it. And the same is true for an asset. Equity accounts have the same role in part. Our retained earnings, our additional paid-in capital, our common stock are all going to have normal credit balances. So to make them go down, I have to do the opposite. But to increase those credit balances, I will credit them. To make my credit get higher, I'll just add another credit to it and add another credit to it. And it'll get bigger and bigger and bigger. But if I want my credit balance in my equity account to go down, I'm going to debit it, makes it smaller and smaller. Now, remember, we talked about revenues and expenses. A revenue account increases equity. So if equity has a credit balance normally, if I'm going to make that equity go up either directly through common stock or retained earnings, then I use a credit. But the same is true with the revenue. Revenue is going to be increasing your equity. So the normal balance for an equity account or for a revenue account is going to be a credit balance. However, the opposite is true for expenses. The expenses is going to be a use of resources to earn revenue. It reduces equity. It lowers the amount of money that's available to stockholders should they receive it in the form of a dividend. So my debit to my expense account is essentially telling the system that I am reducing my equity because I used that money. I used it to generate, or I used it because in order to generate revenue, I had to incur this expense. So expenses reduces the equity, which is why they are debited. It's still a reduction in equity, and we reduce equity in general with debits. Now, there's a catch-all here, and that's dividends. Dividends are repayment to stockholders for their share of earnings, right? Well, it's in the equity section, generally speaking. But what happens with that is that you have to think about dividends is going to be reducing equity. Why? Because we're taking the money out and giving it to the owner. So it's no longer ours anymore. Now it belongs to the owner. If you're going to take the money out, you're reducing your equity. Therefore, the dividend account will always have a debit balance because it is a contra or an offsetting or a reduction in equity. Now, when we record transactions, we have to first of all know when we recorded the transactions, because again, the timing of recording transactions is very important. And then we're in this simulated situation where we're doing things in Excel spreadsheets and all of that. But in the real world, the transaction date is the paramount thing because it's going to determine what accounting period it is in. It determines what financial statement report that information will be transferred to. So it's important to note the date is critical. The title of the transaction to be debited. Again, we talked about this. What happened in this transaction? What's going on? XYZ purchased $500 in cash for office supplies. Now we've got office supplies and we've got cash. We pay cash. So I know if I'm paying cash, my money in my bank account is going down. It's not going up. So I know right off the top, I'm going to reduce my cash because my cash is going down. But I also purchased an asset. So I'm increasing my asset of supplies because until you use your asset, it is not an expense. Therefore, which is one of the biggest problems that students have when they're recording the different transactions. You know, you got to be certain your supplies are assets until used. So I debit my supplies asset and I credit my cash. And so the most important thing for part 2 is understanding exactly what happened and looking at the critical terms used in the transaction narrative. Pay $500 in cash for supplies. Here we go. Now, the title of the account to be credited is going to be in here. Now, let's look at how we're going to show this. The whole process of recording it. Now, I'm going to put you on pause for a second and show you exactly how to record these transactions. So when we look at transactions, when we're trying to understand how to record a transaction, it is important to kind of look at exactly the transaction description. So if we describe that I purchased supplies for $500 with cash, we already see 2 of the accounts already. Supplies, and then cash. These are the 2 accounts. So now the question then becomes, if my cash is going down because I paid for it, because you know when you're buying something, you're going to give them some money for it. So I already know that. So then we have here $500 for office supplies. And I'm going to click on here just to give it a description. And here is my transaction. The date, again, is the date that is given you. I purchased on January the 5th, 2021, $500 for office supplies. And so that's how you'll need to start looking at these transactions to truly critically review exactly what's happening with these transactions and then how the best way to record them. Using T accounts is a great way to visualize exactly what the ending balances would be for various accounts after you've entered all the transactions. It's a great tool. But in the real world, T account really doesn't exist. It's almost the same as a general ledger. The general ledger gives you all of the accounts and all of the activity, ins and outs of all accounts, so that you can use that information to prepare a trial balance, an unadjusted trial balance, by the way. So my hope with this is to show you that it's not necessarily critical for you to get upset about, I don't know what a T account is or what does it mean. Understand what the purpose of a T account, and that should really make it much more intuitive and also help you understand how to use this tool, because it's only for the purpose of you identifying for each account what the ending balances are. And how do you know if the ending balance is correct? You can look at each individual transaction and see what transactions that were recorded in this account, and then you can determine if an error was made. It truly is a point of you identifying all the transactions by account, and for analysis, if you're having some issues with your transactions not balancing, meaning your trial balance isn't balanced, you can have a tool to go back and check and see what accounts that I made a mistake in, what account balance, ending balance is incorrect. Can I identify every transaction for an account that is legitimate? Did I make a mistake? So a T account is helpful to help you identify the transactions, help you identify errors if they are any, and it also provides you an ending balance per account. And that's the whole point of it. So don't get upset about the T accounts as being, I don't understand them. Understand what it gives you. That's really the most important thing. What does a T account provide you? It gives you a detail of all the transactions for a particular account. And then it's useful for preparing an unadjusted trial balance. And if you look at it that simply, I believe it will be helpful to you. Now that we had an opportunity to look at the transactions, I'm going to go back and talk about some type of transactions that are unique. Prepaid expenses are also important to note, and they're unique. If you purchased insurance for 12 months or even 36 months, which is 3 years, advance payments of expenses is an asset. You have the right to use the insurance over 36 months. But the moment you purchase it, it is not an expense. Remember, expenses are recorded when you've incurred or used them. You haven't used your insurance yet. So what do? How do you record a transaction like that? Well, you need to show I have an asset. I have a future benefit of insurance of $3,600. And that's going to be an asset to me. It's an asset until it's used. And it's over the period of time that you use it, not all at once. Meaning, if you have a 36-month insurance policy that you've paid in advance, you're going to be allocating only 1 month per, 1/36 of that every single month until it's paid off. And then when you record your transactions, you need to record only the amount of the expense that was used during that period of time. So that's important to note. If expenses have not been used, if you have purchased something, you have an expense and you haven't used it yet, it's a prepaid. It belongs on the asset side of the balance sheet. Now, what if you receive money from your client but haven't done the work yet? You're going to do it at some point, but you haven't done it yet. That's a liability. You owe them a service or a product. If you owe them a product or a service, it's revenue that you have not earned, and it's a liability. So that's important to note, that you may not see that in your project, but you will see it in transactions in your homework and on the comprehensive problem. If you have not earned it, it should not be reflected as revenue at all. It is an obligation to provide that service or product. And so therefore, if you got money in advance and you haven't done any work yet, don't record it as revenue. It would be inappropriate and incorrect. And that's another thing, which is why we're bringing up these various accounts that are kind of unique, that really don't fit the mold, but want to identify them, because if you see that you got money, but we haven't done the work yet, what does that mean? Well, I have to pay it back if I don't do the work. So I have an obligation. Receivables, the same thing. You did the work, you earned the money, but your relationship with your client says, I will pay you in 30 days following the receipt of an invoice. Well, you still have to record your revenue. You have to record your revenue. But what do? I haven't gotten the cash. We don't care. Accrual-based accounting doesn't care when the money comes in. Have you earned it? Have you incurred it? Now you record it. So if you haven't got the money that you've earned, you still won't recognize your revenue, which is going to be, again, a credit. You have to recognize the fact that you have an asset that is expected. That asset is going to be money. So to record that expectation of money, you have to record accounts receivable. Now, remember, this is all about accounts receivable relating to customers. So this is like a trade receivable. This is going to be a very liquid, a very a current asset on your books. Very important. There are other types of receivables, but let's just deal with receivable related to customer transactions, customer-client transactions. Now, again, once your transactions are recorded and you have transferred them to a general ledger, or in this case, a T account, you now have the building blocks to prepare your unadjusted trial balance. Now, a trial balance has one real important purpose. It gives you a listing of accounts at their ending balances in debit credit format. The trial balance always equals. That means that that's one of the ways that you can find out if there's a mistake on your trial balance. If your debits do not equal your credits, there's got to be an error. It does not necessarily mean that your debits and credits, if they equal your trial balance, is correct, but that's a really important indicator of an error if they don't balance. So the trial balance gives you the list of all your accounts and your ending balances. It provides you with your it just makes certain that all of your transactions are recorded. That's one of the ways that students have identified errors, not necessarily problems with understanding the material, but sometimes when you are recording your transactions and you transfer them to your T accounts, in this case, your journal ledger, sometimes an error may occur. And this is one way to catch errors. It's a very important step, in my opinion, particularly when you're learning how to use accounting and you're using a manually based system to record, transfer, and post and prepare your statements. So remember, trial balance is a list of accounts in debit credit format, and it should always equal. It is unadjusted because it does not have entries recorded to its ledger that are, unadjusted accruals or use of assets that have not been recorded. Depreciation has not been recorded. So it's most certainly an unadjusted trial balance, and you will not use it in its current form to prepare your statements until it's adjusted. Now, when you're recording your transactions on your trial balance, be careful about transposition. But more importantly, even before you're doing your trial balance, the most important thing is make certain that your transactions as you're journalizing are correct. That's going to be the key, because most of the problems that I've seen in students have been all related to the fact that the entry is not correct. But once the entry is correct, there are some things that you can be aware of when you're recording your transactions to your T accounts. Record them entry by entry, one at a time. Make certain that they're done correctly. Once you've done that and you've transferred your balances, your ending balances, to your trial balance, transposition is a very common mistake and easily to find, but not always a common error. Most of the errors that I've seen have nothing to do with transposition. Sometimes it has to do with you copying them incorrectly, meaning you put an extra zero. I've seen that quite a bit. And also sometimes you'll put them in a debit should have been a credit. You just put them in the wrong cell within the Excel spreadsheet. Those are little mistakes that I can easily find, and I will catch those errors and bring them to your attention. But it's good to know that if you look at them and you are able to find different types of common mistakes, less likely for me to find them because you would have fixed them prior to them being submitted. The most important thing is there are some errors that are not related to a mistake. They might be have to deal with supplies or that's being used, or supplies that have been stolen or thrown away. Those kind of errors that you may have to fix in a journal entry are fine, and they are a normal part of business. What I think happens with this course is students don't make those kind of mistakes. They are generally errors of not transferring the transactions correctly to their T accounts. That's a very major problem. And I'm always suggesting once your entries are recorded, you immediately transfer them over to your T accounts. If you have questions about the entry, you can always send an email to me and ask me what kind of, whether or not this question or this particular transaction is journalized correctly. But that's the most critical mistake that students make, transferring those entries to the T accounts, which can be cumbersome. But if you take your time and you do them step by step, entry by entry, you should be fine. Now, decision making. Now, I would say that's the step that I wouldn't go in this particular video. I do want to talk about why are we doing these type of entries. We are doing what a computer normally would do. We are doing in an Excel spreadsheet or within Cengage the transactions that are transparent when you're using QuickBooks. But it's important for you to know why we're doing these transactions and understand what's happening so that when decisions need to be made and transactions are analyzed, they're recorded correctly, they make sense, and your entries can be relied on in the form of financial statements. I hope this analysis gives you some idea that understanding the accounts, understanding the structure, understanding why the transactions are analyzed the way they're analyzed, and using the accounts in the appropriate way, creating the transactions via journalizing is not as difficult as it may seem. The T accounts are purposeful because they allow you to see all transactions, debit and credit, for each account, and it gives you an ending balance. And it's a useful tool in detecting and correcting an error. I hope this is helpful to you, and I wish you good luck.